In the bustling world of trading, one key concept stands out as a market driver: liquidity. Today, we delve into this crucial subject. Imagine a bustling marketplace filled with buyers and sellers, each eager to strike a deal. In this world, liquidity is the invisible hand that guides the flow of transactions. It's the lifeblood of the market, the oil that keeps the gears of trade turning smoothly. When liquidity is high, assets move freely, deals are struck, fortunes are made. But when liquidity dries up, the marketplace can grind to a halt, leaving traders and investors in a bind. Over the next several minutes, we'll unravel the intricacies of liquidity, shedding light on its importance in trading and the broader financial landscape. We'll examine what it means for an asset to be liquid, how liquidity impacts pricing and trading volume, and why understanding liquidity is vital for every trader. So buckle up and get ready to understand the essence of liquidity in trading. What exactly is liquidity? It may sound complicated, but it's a fairly straightforward concept. Let's break it down. Imagine you're at a bustling fruit market. You have a cart full of apples that you want to sell. If there's a crowd of eager buyers ready to purchase your apples at the going rate, then you can sell your apples quickly and easily without having to lower your prices. This is a liquid situation. Now let's change the scenario a bit. Suppose you're at the same market, but this time you're trying to sell a rare tropical fruit that few people know about or want. Even if you find a buyer, you might have to lower your price significantly to make the sale. This is an illiquid situation. Applying this to the world of trading, liquidity refers to the ability to buy or sell an asset, be it stocks, bonds, currencies, or commodities, quickly and easily without causing a significant change in its price. High liquidity means there are many buyers and sellers, and transactions can happen swiftly and smoothly. Low liquidity, on the other hand, means there are fewer buyers and sellers, which may make it harder to complete transactions without affecting the asset's price. Some assets are more liquid than others. For example, large cap stocks and major currencies are typically very liquid. They're traded in high volumes, and you can usually buy or sell these assets quickly and easily. On the other hand, assets like real estate or certain collectibles are considered illiquid. They can take a long time to sell, and you might have to adjust the price significantly to attract a buyer. So, in a nutshell, liquidity is all about how quickly and easily an asset can be bought or sold in the market without impacting its price. Recognizing the liquidity of an asset is crucial in trading, as it can influence your strategy, potential returns, and the level of risk you're willing to take. Now that we understand what liquidity is, why should traders care about it? Well, liquidity in essence is the lifeblood of the financial markets. It's the reason why traders can buy and sell assets quickly and at a fair price. It's the glue that holds the market together and ensures its smooth functioning. Let's take a look at how liquidity impacts pricing. In a highly liquid market, the difference between the buying price and the selling price of an asset, known as the bid-ask spread, is usually quite narrow. This is because there are plenty of buyers and sellers, and competition among them drives the spread down. Conversely, in a low liquidity market, the spread is wide, making the asset more expensive to trade. Now think about trading volume. High liquidity often translates to high trading volume. Why? Because the easier it is to buy and sell an asset without affecting its price, the more trades will likely take place. But it doesn't stop there. Liquidity also plays a pivotal role in market stability. Consider a scenario where a piece of news triggers a sell-off in the market. In a liquid market, the presence of many buyers absorbs the impact, preventing a rapid price decline. On the other hand, if the market is illiquid, a sudden rush to sell can cause prices to plummet, leading to market crashes. Take, for example, the housing market crash of 2008. The market was illiquid with few buyers willing to purchase homes. When the bubble burst, sellers outnumbered buyers by a large margin, causing home prices to fall drastically. This led to a chain reaction that eventually resulted in a global financial crisis. That's why liquidity is so vital in trading. It not only affects the cost of trading, but also the ease and speed at which transactions can be completed. It influences the stability of the market and ultimately the confidence of traders and investors. So it's safe to say that liquidity isn't just about how quickly you can cash in your assets. It's a measure of market health and a key factor that can make or break your trading experience. As we can see, liquidity is not just a concept, but a vital cog in the wheel of financial markets. Liquidity doesn't exist in a vacuum. Several factors influence it in the market. Let's delve into a few key elements that contribute to market liquidity. First off, market participants. A market thrives on its participants, the buyers and sellers. More participants mean more transactions, leading to a more liquid market. This is why major exchanges with thousands of participants tend to have higher liquidity than smaller, less active ones. Next, we have economic conditions. The state of the economy can greatly influence market liquidity. In a robust economy, businesses thrive, and investors are more willing to buy assets, promoting liquidity. On the flip side, during economic downturns, investors may be more hesitant, potentially leading to decreased liquidity. Market news also plays a role. News about a company or the economy can cause investors to buy or sell assets. For instance, positive news about a company can lead to increased buying activity, making the company's stock more liquid. Conversely, negative news can lead to selling, which, while increasing liquidity in the short term, may result in a less liquid market if the news is significantly bad and causes investors to abandon the asset. Then there's market hours. Yes, timing matters. Trading volumes and hence liquidity can vary throughout the day. Usually, markets are most liquid at the start of the trading day, when news from overnight is absorbed, and towards the end of the day, when traders close their positions. Lastly, let's consider regulatory policies. Regulations can impact market liquidity. Policies that make it easy for buyers and sellers to transact can enhance liquidity, while those that impose stringent rules may deter participation, potentially reducing liquidity. To visualize these influences, let's imagine a graph. The x-axis represents time, the y-axis represents liquidity. As each factor we discussed comes into play, the line on the graph fluctuates, demonstrating how market liquidity can change under various conditions. These factors, among others, play a crucial role in determining the liquidity of a market. Liquidity isn't uniform. It varies dramatically across different markets. Let's take a journey through some of these markets and examine their individual liquidity characteristics. First, let's consider the stock market. It's often seen as a highly liquid market, especially when talking about large-cap stocks. These are traded in high volumes, making buying and selling a relatively smooth process. However, smaller-cap stocks may not enjoy the same level of liquidity and can be more susceptible to price fluctuations. Then, we have the bond market. While it's a sizable market, it's generally less liquid than the stock market. This is because bonds, particularly corporate and municipal bonds, are not traded as frequently. The lack of frequent trading can lead to larger price swings when buy or sell orders come in. Next is the Forex market. It is considered one of the most liquid markets in the world. Currency pairs like US dollar to euro or British pound to Japanese yen are traded around the clock, ensuring high liquidity levels at almost any time. Lastly, let's touch on the cryptocurrency market. It's a newer market, and its liquidity can vary widely. Popular cryptocurrencies like Bitcoin and Ethereum tend to have higher liquidity. However, less-known cryptocurrencies may have lower liquidity, leading to potentially larger price swings. Each market has its own unique liquidity profile, presenting different opportunities and challenges for traders. Understanding these differences is crucial in making informed trading decisions. Traders are always on the lookout for opportunities, and liquidity often provides just that. High liquidity markets, like certain stocks and currencies, offer traders the chance to quickly buy and sell assets without causing a significant price change. This rapid trading can lead to potential profits if played correctly. One approach is scalping, where traders make numerous trades within a day, capitalizing on small price movements made possible by high liquidity. On the other hand, low liquidity markets can also present unique opportunities. These assets are often prone to larger price swings due to their limited buyers and sellers. Traders with a high risk tolerance might find these markets appealing. For example, trading in certain illiquid cryptocurrencies or penny stocks can yield significant returns if the trader accurately anticipates a substantial price movement. By understanding and leveraging liquidity, traders can make more informed and potentially profitable decisions. But it's not all smooth sailing. Trading in low liquidity markets comes with its own set of risks. First, let's talk about price slippage. This is when the price you expect to buy or sell at isn't the price you actually get. It's like aiming for a moving target. When liquidity is low, there are fewer buyers and sellers, so a large order can significantly move the market price, causing slippage. Next up is high volatility. Low liquidity can lead to wild price swings, making the market unpredictable. This can be a trader's worst nightmare, especially when trying to exit a position quickly. So how can you navigate these choppy waters? Here are a couple of tips. 1. Always have a well-thought-out trading plan. 2. Consider using limit orders to control the price you're willing to buy or sell at. While liquidity offers opportunities, it's important to be aware of the risks and manage them effectively. We've covered a lot of ground today, from defining liquidity to understanding its role in trading. We've delved into the importance of liquidity in the smooth functioning of financial markets, examined the factors that influence it, and compared its presence across different markets. We've also discussed how traders leverage liquidity and the challenges they may face in low liquidity situations. Understanding liquidity is a fundamental step towards successful trading. So keep learning, keep trading, and stay liquid. Stay